Hello everybody, it's me here, Cameron, and warm welcome to the How to Cameron channel. Welcome to a finance video. Just start by saying this isn't strictly financial advice. The intention of this video is to make you guys think. So hopefully it provokes that. And if it provokes that, this video is a success. That's how I look at it. Today we're going to be talking about the myth, the costly myth of holding a stock. We're looking at AMD here. AMD is a stock that I own 600 quid in, nearly 7 shares, and it's a stock that's done really well. It's a nice problem to have, the problem I've had here. So my cost average was just shy of $80, and from $80 this stock climbed all the way up to 130. You know, that's over a 50% incline. And I remember thinking to myself, like, I've never had a stock return, 50-55% in 3 months. Like, what do I do? And I remember checking Tipranks, and what I noticed was quite baffling to me. So you've got 29 analysts, 21 ranking the stock a buy, 8 ranking the stock a hold, and no one considering it a sell. Now I think selling stocks is harder than buying stocks. That's how I look at it. I think that's very complicated. But when it comes to holding, I just don't get it. Holding is the same as buying a stock. And I want to visualize the only difference between buying a stock and holding a stock. And I want to highlight that in actuality, there's no difference. Really, there's no difference. Before this video starts, if you guys do enjoy it, smash that like button, subscribe to the channel if you're new today. If you guys enjoyed this video, I'll be sure to do more videos talking about finance. I love investing. It's something I'm very passionate about. So let's say you bought this stock for $80 at the start of March. That means your starting position is $800, right? Now, what's happened is that price has peaked. We'll just call it 110. It has dropped off from its peak, but we'll look at what it is at right now. So right now, in the period of 3 months, you now have 1.1 grand. So that means that now, that amount of money, $300 of that, is gains. And then $800 of that is the coal mine. We're coal miners. Let's pretend we're a coal miner, right? We've earned the money from work. We've put the money into the stock. We now have in that holding $300 from gains, unrealized gains, and $800 from the coal mine, from us mining coal. Now let's say we were to just buy the shares right now. You own the same amount of shares and it's worth the same amount of money. Okay, the only difference is the source of funds. That's literally the only difference. Now here's the thing, I believe that the top investors, the key characteristic they have is they don't invest on emotion. The only difference is where the money came from, and that is substantiated by emotions. Because it came from the coal mine, we worked for it. So because of that, the difference in putting 100% equity from the coal mine into a stock, that is much worse than maybe $300 of it being from capital gains. The only difference is the emotional side of it, and that to me is an invalid reason. Just because it was harder to get the £1,100, the $1,100 in this case, to buy the stocks at market price right now, it doesn't mean that it's worth anything different if we bought it at $800 worth and we've made some capital gains on it. It's still the same amount of money. So what I'm pretty much saying is that buying shares is the same as holding shares. When you are at $110 a share, you're in these two positions here. Okay, what you do at that point comes from the same grounds. It's worth the same amount of money. The only difference is the emotional insight to how you got that money to begin with. Just because they're unrealized gains, it doesn't mean it's free money. And that's the problem. I think a lot of people, they invest in a stock, it does well, and then they look at the gains they've made off that, and they come up with this idea that, oh, well, it came from gains, so that means that, we can lose it. No, it doesn't work like that. And that's the thing with holding stocks. I think a lot of people fall into that trap of thinking because it's gains, the money's worth less than if you got it all from the coal mine. And that's the big flaw. in holding a stock. When you hold a stock, you are effectively buying that stock at the higher price. I can tell you AMD going up 60% in the last 3 months. Does that show 60% more that it's a value pick? Probably not so much, and that's why I sold about half my position. Now, I'm not saying sell your full position, but definitely think about selling it. Okay, if you'd buy that stock at the price it's gone up to now, keep the stock, hold the stock, there's nothing wrong with that. But if you are in a position where you think the stock price is too high, just because you've made gains on it, it doesn't mean that you shouldn't sell it. Another example I want to bring in, and this is something I find quite interesting, is there's a YouTube account, and you see this a lot with investing. Okay, so we'll find this channel, it's called Everything Money. They're a good channel, I'm interested by them, but it just signifies the bias between holding a stock and buying a stock. It's honestly crazy. They will make videos where they evaluate stocks. So they'll evaluate, the popular companies that everyone is searching up about. And they are incredibly pragmatic, they're incredibly negative, and they're only looking to enter prices which are dismal. Like, they're looking to buy stocks at the absolute cheap. So they have this model, it's like a calculator on their website, and they work out what they believe is the value price. I think it's a discounted cash flow model. So what they're pretty much saying is that they're looking for this price. They're looking for a price of Disney at $76, $68. That's what they believe is a value. So right now with Disney stock, based on their method of analysis, they wouldn't buy it. So right now it's at $90 a share. So it's $68, $70. They're looking for a bigger decline, even though, may I mention, the stock is completely fell off. So they're looking for an even bigger loss. Now, there's nothing wrong with that. It's very important that with investing, you're entering at the correct time. But what I find funny about this channel is they never talk about selling stocks. They literally never make a video saying, okay, we think this stock price is good now, so we're going to sell the stock. They focus so much in getting the stock as cheap as possible, but then when it comes to the question of, okay, should we sell the stock, they just don't care about it, which is the more important part. Okay, it's more important to sell your stock, because if you're not selling your stock, you're holding your stock, which means you're buying the stock at a higher price. So yeah, you can be super pragmatic about your initial entry point, but if you're just staying in that stock as it goes up and up and up, you're pretty much buying that stock at a higher price. Even with dividends, and I was thinking about this a lot, like, even with dividends, your yield on cost is the same. Yes, there is an inherent benefit to, owning and holding a dividend stock. Obviously you're getting paid the dividends, but your yield on cost doesn't change. So what I mean by that is if you have VHYL, so VHYL is the Vanguard High Dividend FTSE ETF, or World Dividend ETF, or World High Dividend FTSE ETF. It's a bit of a tongue twister. If you bought that, £50 a share, and let's say you bought 10 shares of it, that'd be £500. And then if it went up by 20%, it'd be 60, and you'd have 10 shares of that, and that'd be worth £600. Now this pays a 4% dividend, so 4% on 50 is £2. Right now, your yield on cost would still be 4%, because your yield on cost, and this is another term which I think is a bit of a bullshit term, because it's signifying that the cost is just what you invested. So your yield on cost would be 240 over 50. Your yield on cost would be up because it'd be 4.8%. But here's the thing, I don't believe in the yield of cost. I think it's an awful metric, because yeah, you went to the coal mine, you put 500 quid in, it came from the coal mine. That £50 a share went up by 20%, and now 20% of the money you have in that ETF in this case comes from gains, and only 80% from the coal mine. But here's the thing, all of that is still a cost, because those gains are money. It's still money, it's the same thing, it's still money. It just came from somewhere else. And that's why I don't believe in the yield of cost, because the cost it's still money. Okay, yeah, it's gains, but you're still paying for the share price. Yes, it came from, not the coal mine, it came from gains. But it's still money. It's still money that could be elsewhere. So you look at the yield on cost, and yeah, your yield on cost grows and grows, and it goes up more and more and more. But that's because it just treats the gains that you make, it treats it with a privilege that it shouldn't treat it with, because it's still invested money. Anyway guys, I've done a lot of rambling. I don't know how this video turned out. I really don't. I don't know if anyone will even watch it. But the point of this video is to spark a bit of conversation. That's all I care about. Like, I'm not a genius. This video is to spark conversation, and I will be sure to do more videos talking about investing and stuff in the future. But thank you guys for watching. If you guys enjoyed it, smash the like button, subscribe to the channel if you're new today, and I'll be seeing you guys later. Take care.